Okay, welcome to my 9th video of my 11-part series on the hard landing and why I think a recession is incoming. The previous videos I talked about the business cycle and how we got to where we are today. And I really want to talk about the stock market. One, because I'm really into it, I guess you'd say. And two, because I think it's wise for people to kind of know where we're at and possibly know where we might be heading so that they don't over risk their investments and can maybe hedge against any uncertainty going forward. So let's get into it. So how do stocks perform during a recession? Okay, we'll start there. This is the S&P 500. So when people talk about stock market, they typically are referring to this. And people are always trying to beat the S&P 500. Okay, so this is the 500 largest U.S. stocks in the stock market, and it's really hard to beat. Okay, because the S&P 500 has the top 500. Really the best of the best. And if you look at this chart during the dot-com bubble, it dropped 46%. Okay, so if you have all your money in the S&P 500, just know it does have these huge swings due to the business cycle. Okay, and then in 2008, it dropped 52%. Okay, so half your net worth could drop over, just a year. This was how many days with this? This is like 2 years maybe. And then I tried to show this time frame on this blue line. So you peaked from the dot-com bubble, crashed, you finally recovered, and then you had the 2008 financial crisis. Okay, and then you fought back again. If you invested right here near the top, you would have had to wait 12 and a half years just to break even. Okay, I know I'm kind of cherry picking the data, but some could argue that we're right here. Okay, and who knows how deep of a crash we could get. 12 and a half years. I mean, can you write it out for 12 and a half years when you're in the best, the best index really there is? I mean, this is not even to show what the other stocks did during these times. I mean, imagine how many stocks went bankrupt, lost 99% of their value. I mean, even just in 2022 that happened. So this is just showing the S&P 500 and what could happen. Let's look at some others. This is Microsoft. And Microsoft was really overvalued during the dot-com bubble. And over the next, let's see, it looks like 10, 11 years, it dropped 72%. Okay, I mean, if you bought Microsoft at its peak, you had a tough ride. Okay, and then it didn't recover for almost 17 years. I mean, this is a decade and a half that it would take to recover your money. If you bought up here and rode that wave, more power to you. But just know that these things do drop in value a ton. Okay, these aren't just, they only go up forever. And let's talk about Japan. In the late 1980s, everybody basically thought Japan was going to take over the world. And they got so overvalued that they dropped 80% over 20 years. And then they finally started to recover and just broke above their previous high. In 2023, it looks like, maybe 2024. 34 years it took to recover in the Japan market. 34 years. Okay, this is a whole lifetime of investing. I know Japan's a one-off, but like these things happen. Okay, look at the write-up. Look at the 1980s. I mean, people were so bullish. Okay, does this remind you of anything? Okay, let's look at where we are today. This is the the Buffett indicator, they call it. This is what Warren Buffett likes to look at to gauge where we are in the stock market. Warren Buffett indicator hits 195%, the highest level in history, surpassing the dot-com bubble, the global financial crisis, and the 2022 bear market. This is a ratio of the total value of all the publicly traded stocks divided by the GDP, the actual output of the economy. So it kind of shows you how overvalued stocks are in relation to the actual productivity of the economy. We're at the highest ever. I mean, ever. Okay, so if you say that this market's not overvalued, come on. Let's look at individual assets. Gold, all-time high. S&P 500, all-time high. Home prices, all-time high. This is the S&P Case-Shiller. Bitcoin, pretty much all-time high. Okay, this is actually even higher than when I took it. Okay, so, I mean, what do you invest in? Everything's at an all-time high. Okay, so what happens when there's a bubble? And, a lot of the times right before you hit a recession, is you have these huge concentrations in one asset or one type of asset. And in 2000, it was, the dot-coms. And what we're now seeing is a big similarity in AI stocks. And this shows the top 10 stocks weight in S&P 500. And we're right at 31. This is from Goldman Sachs. And this is the highest ever. We've come down a little bit, but this is the highest percentage. So think about it. If you invest in the S&P 500, over about a third of the money you invest goes into 10 stocks. And guess what? They're pretty much all tech/AI. So, you're not as diversified as you think. Now let's go to the top 7, the Mag 7 you've probably heard of. The Mag 7 are worth more than any non-US national market. They're worth more than China, Japan, India. I think they're worth 15.7. I'm pretty sure they're worth all of these combined. They're worth all of Japan over combined. Or maybe India over combined. Anyways, I mean, look at this. From the Kobayashi letter, to put this into perspective, the total U.S. stock market is worth $50 trillion, just 3 times more than the Magnificent Seven. The whole stock market is only 3 times greater than the Magnificent Seven. Yeah, 31%. So, I mean, here's your concentration. Let's look at the Mag 5. Okay, NVIDIA, Microsoft, Alphabet, Amazon, Meta. You're only missing, Apple and Tesla. And this was on July 5th. This might be slightly different because it was about 11 days ago. They accounted for 63% of the S&P 500 gain. I believe this is year to date. 63% of this came from 5 stocks. Okay? I mean, and they're all tech. And then this is the S&P 500 equal weighted index over the S&P 500 weighted index. And essentially, as you get greater concentration towards those larger companies, this ratio goes down. And we're right at levels of, you guessed it, 2008. Okay, and this, you know what happened in 2008? Yeah, December 2008. Okay, so now let's talk about one stock. You all guessed it, NVIDIA. And I just want you to look at this comparison of NVIDIA now versus Cisco in 2000. This is enterprise value as a percentage of GDP. Okay, NVIDIA is 11.7% of GDP. Just think about that. Over a tenth of the GDP is the value of NVIDIA. NVIDIA is the number one largest company in the stock market. They just went above Apple. I mean, think about Apple as a company, and NVIDIA just skyrocketed past it as the largest company. It's just crazy. And Cisco was only at 5.5% of GDP. Okay? I mean, look at this, is double Cisco. And Cisco was the largest company back in the dot-com bubble. This was like considered the most overvalued stock. Because, I mean, look at this crash it had. And look at NVIDIA. This is a crazy chart. Cisco Systems was the most valuable company in the world. Its stock price had reached a high of $80. 37 times the sales. Yeah, so it says Cisco's stock price would fall 89% over the next 2.5 years. The stock price has yet to return to its prior high in the 24 years since. So I like to show you guys actual charts and data as opposed to just people's predictions, because you see all over the internet, oh, NVIDIA will hit 50 trillion in market cap. Oh, NVIDIA will fall by 95%. Predicts this bank or predicts this investor. I'm like, let's just look at the chart. And yeah, it's overvalued. NVIDIA is one of the largest threats to the US stock market. It is extremely overvalued. This is Global Markets Investor. The price to sales ratio of NVIDIA is 40 times. The next highest in the Mag 5, I believe this is, part of the Mag 7, is 15x. Okay, this is what, 2.5 times the next highest? So the price you pay to buy NVIDIA is 40 times the amount of sales they have each year. And think about that. So, yeah, I think it's overvalued. And this is probably my favorite slide of this whole entire series. Walmart Insider Trading Alert. Samuel Robson Walton, chairman and heir to the Walmart fortune, just dumped another 2.5 million shares worth $162 million. He's now sold over $2 billion worth this year. Another Walmart Insider Trading Alert. Same guy, $1.7 billion. Dell Insider Trading Alert. CEO Michael Dell making his total more than $2.1 billion. NVIDIA, the CEO, now sold a total of $275 million over the last month. Amazon, founder Jeff Bezos, plans to dump $5 billion worth of Amazon shares, bringing his year-to-date over $13 billion. And yes, this did happen. Oracle Insider Trading Alert. Founder and chairman Larry Ellison, $640 million he sold. Amazon, oh yeah, this is showing that he's now sold over $10 billion this year, so he actually did sell or the $13 billion that he's planning. Airbnb, the insiders sold $55 million. This was the co-founder and the CEO. Okay, so what are we seeing right here? Right here, the founders and CEOs and heirs, the Walmart heirs, are selling their fortunes of the companies they own. Okay, normally this would be a huge red flag. Okay, if the CEOs and founders were selling, but this stock market we're in, is just so, risk on, that people don't even see this. I mean, this is alarming. And you see this right before huge sell-offs. And I'm going to show you here right now. This was in 2021, November 17th, 2021, so the very end. And Chamath Palihapitiya, I think is his name, from All In Podcast, went on this huge rant about how Elon Musk and Jeff Bezos were all selling a ton of their shares. And he ends it by saying, if the smartest people in the world are now selling their core holdings, that they told you they would never sell, and you are not reconsidering your position on things, you're either much smarter than them or you're being really, really reckless. What happened in 2022? 1 month later, over the first 9 months of 2022, the S&P 500 dropped 25%. 2022, like I said in the previous video, was absolutely brutal. I mean, a lot of stocks fell 99%. A lot of companies went out of business. You see this. The smartest and richest people always act first. Okay? They may not be the smartest, but they hired the smartest people to manage their money. Okay? And you always see them rotate first. Okay? So a lot of people say, I think it's going to go up and up until the election, and after the election it'll fall. Okay, well, think about this. If everybody thinks that, then everybody's going to pull out prior because they don't want to be holding the bag. So if they think that as well, they'll pull out a little bit prior to that. Okay, so what, maybe 4 months before the election? Well, you're now seeing the smartest people and the richest people pull out even before that because they are the smartest. Think about it. They're pulling out before everybody else. They know more than us. So that's basically the state of the stock market and what I am seeing, at least. And you might say, okay, well, where do I deploy my money? And I can't personally give you any recommendations, but I will show you in the preparation video exactly where I'm allocating my money. And hopefully it can kind of give you some insight. So I want to end this by talking about credit spreads, because this is the biggest argument onto why people don't think the stock market's about to crash. And basically what this is showing is junk bond yields in light blue and the US 10-year yield in purple. And what you see right before recessions is they call it a blowout, where the junk bonds rate skyrocket. So basically when it gets risky out there and I guess risk adverse and people start to fear, they start charging huge rates to own these junk bonds. Look at 2008. People are saying, I'm not buying your junk bonds unless I'm not loaning to you unless you give me this huge rate back. And junk bonds are just indicated by the rating that they get. So these are actually, from a chart. But what you see is they start to diverge. Okay, so junk bonds go up in rates, and what happens to the 10-year? They start to fall, typically because the Fed cuts short-term rates. And when the Fed cuts short-term rates, the 10-year starts to fall. Maybe not as fast, but it still falls, typically. That's what you see here prior to the pandemic is you see the rates fall and then the rates rise. So they diverge. And you see it almost every time. So let's look at the next chart. This shows the difference. Okay, this shows the exact difference between them. And basically, when you go up, they diverge. Okay, and you see this prior to every recession. Okay, you have some up and downs, but you do see it. Okay, so this, I'm not sure exactly what this was. This might have been the bank scare last year. But look at where we are now. I mean, we're almost at all-time lows. So people are saying, okay, if the credit spreads aren't rising, I'm not worried at all. I mean, why would I be? I mean, I should only worry really if the credit spreads start to increase. Then I know, okay, then it's risky to be risk on. But people are risky right now. I mean, they are total risk on. And you will notice that, prior to this, it always is the lowest. And they know that, but their rebuttal is, well, it hasn't even started to go up yet. So I do have a rebuttal to their rebuttal, and it's just a theory that I learned from George Gammon. And here's the theory, is that banks, when federal funds rates were low, this is going to get complicated, so just try to bear with me. When short-term rates were low, they think you could borrow at short-term for like, say, 1%, and then you could go ahead and buy 10-year bonds at just say 3%. Okay, so you borrow short and you buy long. So you're paying per month 1% on this loan, and then you're getting 3% on the other. Well, what happens when the short-term rates skyrocket, right, to 5.5%, like what they just did? Well, now, since you have to keep paying back the short-term rate, you keep having to roll over the debt, they call it. Okay, so the short-term debt that you borrowed, you got to pay it back, and then you got to roll it over. Okay, so you're paying 5% on the short end, and you're only getting 3% on the long end. Okay, so every month now you're losing money. It's like the opposite, and this caught a lot of banks off guard, and this isn't sustainable. So what do banks do to fix that delta? They go and basically buy junk bonds because they get a higher return on junk bonds than they do on the 10-year. So they're being forced to buy these junk bonds. So with all these banks having to buy these junk bonds, it's sending the rates down, because the more demand for the junk bonds, the lower the rate. So you could, if you looked at the scenario and just said that most banks were doing this, you could theoretically think that the more risk, the lower the junk bonds. I know it's a crazy theory, but that could be why you aren't seeing these junk bonds going up, is because these banks are buying them, sending the rate lower to cover their butts, basically, from getting caught off guard from that rate increase. So that's just a theory. This is definitely something to keep an eye on, closely. Because prior to a recession, you typically see that blowout. So that's my rebuttal, and who knows, right before the recession we may see it increase, but it's something to keep an eye on. Okay, so that's the stock market. Again, I'll tell you in preparation what I am invested in, and where you can put your capital, or where I can put my capital. Okay, so in the next video though, prior to that, I want to talk about catalysts and certain scenarios that might occur that could trigger the snowball effect and really increase the time before we see the recession, or I guess shorten the time. So that's a very important one too. So go ahead and check that one out. Until the next one, Godspeed.